I'll go ahead and skip. And when we're looking now at a 97 LTV value, and we know that, of course, at the height of the market back pre-recession, we were up to 120% for some of the products that were being offered that I think were referred to as more on the predatory side. Are you afraid that being at 97% LTV that we're getting back into that risky area?
No, if you look at, so I touched on ability to repay a little bit earlier, and so these are the regulations that have come down from the CFPB. This is the law, and if you dig into the ability to repay, there are 8 pillars that we as lenders are responsible to make sure that we can attest that we packaged a loan and have met all 8 pillars of the qualification standards with documentation. And they're the things that you would expect: income, credit history, down payment, and those type of those things. They even go so far as to build out in what's called Appendix Q, which is the CFPB's lending guidelines, which looks a lot like the credit guidelines, again, I worked with in the 80s and 90s. It's back to traditional credit. Now, the impact for a lender that, and this is the overarching law of CFPB, what lives underneath that is qualified mortgages and qualified residential mortgages, which are subsets. But at this highest level, if you violate that and you issue a loan, I mean, the penalties on that, start out at $5,000 a day and then start climbing up from there if it's a Tier 2 or Tier 3 breach. So I am comfortable that that law and those regulations are very much having an impact to make sure the fair and unfair and irresponsible lending that started this whole mess in the 2000s is not going to repeat itself.
Thank you, Mr. Collins. Mr. Bostic, Professor Bostic, I have a question for you as well. You touched on that California is expensive. You touched on some of the different factors that go into it, but one of the things that I didn't hear was any reference to CEQA and some of the challenges that face the building community in trying to develop more homes. Would you like to touch on CEQA and possibly any reforms you may see as being evident or necessary for us to be able to assist the building community?
Thank you for your question. CEQA definitely contributes to cost. Right? It is, most developers will build that into a holding period of time, extra reports, all those sorts of things, even for properties where there's already development. And we know that there's what impacts are likely to look like. It impedes the amount of units that come online, and it impedes the speed at which they come online. And I would agree with Mr. Collins. In many metros, high cost is a function of inadequate supply, and we need to find ways to increase and improve the supply. So in terms of modifications to CEQA that might be worth exploring, considering either fast-tracking or carve-outs for properties that involve redevelopment in places where there's already significant density would be something that would be worth considering. Perhaps incentivizing and creating similar sorts of incentives for types of properties that we might think are good ideas and useful, such as transit-oriented development with higher densities. These sorts of properties and projects, I think the state should explore trying to find ways to streamline their production and reduce their costs, and CEQA is definitely part of that. But I should say, as a final thing, CEQA does serve a purpose, right? And I think that the principles behind it are important to not lose track of. But in many of these instances, it's just being used as a vehicle to gum up the process and make things more difficult.
Thank you, Professor, and thank you, Mr. Collins.
Assemblymember Lowe.
Thank you very much, and thank you both for your being here today. Chairman DeBobne and I are part of that demographic in which you showed that the increasing rates of lower home ownership. And I represent Silicon Valley, and even when you have the dynamic in which you have a career teacher with a PhD, they aren't even able to qualify for a loan and or afford to live in the place that they work in. And part of the challenge also exists that in the suburban communities that I represent a number of recalls have occurred from local officials who have supported higher transit corridors, the type of developments that you've referred to near high transit corridors, higher density units, to maximize the land use. If there is one thing that you think a policymaker should be mindful of as it relates to the challenge that exists, in which you have individuals who might demonstrate the NIMBYism, and yet we know that there are good policies that are important to address some of these challenges and these issues. What kind of elements do you think that should be thinking about as it relates to some best practices, perhaps in other states or other countries?
So I would say two things on this. I know you asked for one, but the first is I think we have to touch people's hearts and minds, and so there is a part of this, which is when you make those decisions, that imposes significant costs on other people, and those costs need to be grounded and made real. So when you don't have enough housing that lower income people can afford, they're going to make do, but making do might mean doubling up, tripling up, driving 3 hours to get to work, and that has costs. And then the second piece, which I think is particularly important, is to show that those sorts of things actually allow places to work better. We have many examples across the world, and even in this country, of places that choke themselves to death because they do not create opportunities for people to move to jobs quickly or in a timely fashion, don't give them an opportunity to live in communities that they want to, and that adversely impacts productivity, ultimately. And in Silicon Valley, I don't think we've gotten to that level, but private companies are making decisions now. They are hiring transportation fleets to move their workforce around. That has real cost. And to the extent that those costs could be localized, and actually I should say those costs are now spread across everyone, right? So the entire peninsula now has to deal with the additional traffic and all those sorts of things. And so we want to think about how we might be able to demonstrate those costs and the potential benefits that everyone has. So I would say you need a narrative that hits both of those.
Assemblymember Achachian.
Thank you, Mr. Chair. Mr. Collins, going back to Mrs. Brown's question, which makes a lot of sense, but my understanding that by regulations, banks are not to own real estate. In other words, if you were to foreclose on a house, you have a period of time that you have to turn it back and put it on the market. I stand to be corrected, but is that your understanding, or that's mine?
So I'm not an expert in the foreclosure process, okay? But there are a series of steps they go through, which would include putting it back on the market and going through those steps until ultimately it is sold.
That's why I don't believe that the government allows the bankers to own real estate or get into rentals, simply because they can hold on to, and when the market is better, they can sell and make a killing. They just don't want to see the bankers get into the business of real estate. That's why if you have to foreclose, which is an extended process to go through, it has to go back on the market for sale, otherwise you'll be penalized. Thank you.
I do have one question for Professor Bostic. What are some of the things that other states are currently doing to address the issue of declining home ownership that California can emulate?
Well, that's a good question. Some states don't have the same supply constraint issue that we see here. So in much of the middle of the country, the main response is just to let people build more. And so they can, and so we don't see the same sorts of escalations in price. I didn't bring this slide, but the tremendous run-up that we saw here and that we saw in Miami, we saw in Boston and New York, we didn't see that in the middle of the country. We didn't see that in places where a supply response could happen rapidly, right? So in the Texas areas, in Indiana, Colorado, Ohio, we didn't see the same sort of spike. So this question about supply is important. I think that another issue which is important is down payment assistance. and the extent to which wealth is a barrier. There's research that I've done and that others have done to show that in many instances when people get into a mortgage, they can afford it. But the problem is getting into it, and that often involves having significant or sufficient down payment. And in a high-cost place, the down payment barrier is larger. So those sorts of issues as well. And I think thinking about incentivizing financial institutions to explore with first-time homebuyer programs and try to find creative ways to serve populations that might want to do that is important. I don't think of this at the state level. I think about things like CRA. I know there's been conversations about a dedicated source for housing policies and programs. These are the sorts of policies where you have real focused incentives to try to achieve a goal, and I think those are possible.
Thank you very much. And if there are no further comments or questions, I want to thank the two gentlemen for your presentation today. I'd like to turn it over to my co-chair to introduce the next panel.
Thank you, Mr. Chair. For our next panel, will be an overview of the state and federal programs to assist first-time home buyers. We have Tia Boatman-Patterson, Executive Director of the California Housing Finance Agency, Gail Hall, Director of Legislative Services Bureau, Franchise Tax Board, Todd Delaporto, Senior Director, Residential Lending Strategy and Growth at Fremont Bank. Thank you all for being here, and we'll jump straight in with Ms. Patterson.
Good morning, and thank you, Assembly Members Chow and DeBobne, for giving me the opportunity to speak with you today, and thank you, members of the committee. It's a little odd for me. For several years, I sat on that side of desk as a committee consultant. My name is Tia Boatman-Patterson, and I am the Director for the California Housing Finance Agency. Although our work in multifamily housing, we do also work in the multifamily housing lending market. Today, I'll be giving you an overview of our products and programs for first-time home buyers. California Housing Finance Agency's mission is to create and finance progressive housing solutions so more Californians have a place to call home. This year, CalHFA is celebrating its 40th anniversary as the state's affordable housing bank. Our role, which has historically been to fill in gaps of the private mortgage lending market. As the State Housing Finance Agency, we have relationships with our federal partners and our federal entities and the GSEs like the Federal Housing Administration, Fannie Mae, and Freddie Mac. And through these partnerships and programs that are available exclusively to Housing Finance Agency and our partnerships with lenders, did I do something? Okay. We offer our borrowers advantage like low interest rates and down payment assistance. We want to help the moderate income and credit-worthy and responsible California renters make that transition into home ownership. I'm going to take the time now and talk a little bit about our geography. And you can see there since the beginning of our existence, we've funded about $19.6 billion in mortgages, and we're serving over 153,000 home buyers. I asked staff to pull a couple of statistics for me. And the previous speaker, Mr. Collins, spoke about between 2009 and 2013, you just didn't see a whole lot of banks lending. And so we were in that same boat as well. And so since 2012, we looked at our top counties in which we've been providing our homeowner assistance and our conventional mortgages. And our top counties are Los Angeles, San Bernardino, Sacramento, Riverside, Kern, Fresno, Contra Costa, San Joaquin, Tulare, and San Diego. So those are the top counties that you're seeing us actively involved in. The majority of our buyers, 61%, their incomes are between $60,000 and $100,000, and 31% of our buyers are at $60,000 and below. So you can see that we really are targeting. What we're here to do is to help the low and moderate income buyer. Our single-family home ownership rates have fallen since 2006. We had a high of 60.7% to down to 53.2% in this quarter, and they fell across all groups. Since our first homeownership program was implemented, I mentioned that how many buyers that we have served. And because we are not a direct lender, we use our partnerships with preferred lenders. We have over 100 lenders that we work with. Wells Fargo, who spoke earlier, is one of our partners, and I'm going to, because he wasn't aware of the Keep Your Home California program, I'm happy to answer any questions about the Keep Your Home California program. And I do want to let the committee members know that Wells Fargo was a participant and a great partner in our Keep Your Home California program. Our highest priority has been the targeting the borrowers, and we require customers, like I said, to be credit scores of a minimums and manageable debt. We require a home buyer education. We also put in a home buyer's warranty, because we know that this leads to sustainable home ownership. We saw the results of the last decade when predatory lending and uninformed borrowers played a big part of the Great Recession, and CalHFA is committed to helping borrowers avoid those traps. CalHFA has a fairly narrow focus when it comes to our single-family lending. We are chartered to help homeowners and not investors. We do not allow our loans to be used for investment properties, and we require the owner to actually live in the home. And we don't also allow our lending for second homes or vacation homes. It's for home ownership. We do allow our fundings are available for condominiums and manufactured housing. We have an FHA product that goes for manufactured housing as well. We know that there is a spectrum of affordability in which you build affordable housing and then you make affordable housing affordable. And so we want to make sure that we're striking that balance and that we're looking at that spectrum. We also have upper limits on our sales of our price homes. And because of that focus and those limitations, we are very targeted in our programs. I told you where our current loans were mostly being made, and the demographics of our borrowers and look much like our state of California. Since our CalHFA loan portfolio, 47% of our borrowers are Hispanic Latino. We know that they make up 39% of the California population. Caucasian and white borrowers are 34% of our portfolio, making up 39% of the California population. African Americans are 9% of our borrowers, and they make up about 6% of the population. Asian, we have 4% of our borrowers, and they make up about 13% of our population. And we have other at around 6%. So our products are really targeting and look like the demographics of our state. Our flagship product is the CalPlus mortgage loan that can be used either as a conventional or with the FHA mortgage insurance. The details on these two programs differ slightly. And the value of the CalPlus is that it comes with included a down payment assistance. There has been much research about the importance of down payment assistance, and I believe Mr. Bostic also spoke about the down payment assistance in today's economy. Because many credit-worthy renters are well-paying, well-established jobs simply aren't able to save enough money to come up with the 20% down. That is used as the standard, and even though we now have like a 3 to 5% standard, we still see sometimes that as a barrier. Our products help make that down payment so that they can secure the cost of the housing and start building wealth and transfer to the next generation of Californians, an advantage in today's economy with historically low interest rates and rising rental costs. This fiscal year, we are on track to committing $210 million in funding for 927 mortgage loans. We received some down payment assistance out of the last bound round, which would have been Proposition 1C, and we use that to fund our CHDAP program, which is the California Home Assistance Down Payments Assistance Program. And by the end of this calendar year, we will be out of those that fully allocated those funds. We're working on recycled program funds, but that initial allocation of bond funds will have been completed. Now, there are also 2 homeownership programs which were also funded by the program that were funded by Proposition 1C, and that would have been the Cal Home program, which is administered by my sister agency, which is the Department of Housing and Community Development, and the Begin program, which were both in the form of grants to local government to help with burdens to home ownership. And though it's my understanding that those funds have been completely depleted as well, because they were funded with bond funds. Am I on the right slide? With the ever-increasing climate change and environment, we also think it's important that we offer a product that focuses on those things. We have the Cal EM Plus grant program, which piggybacks on the 5% grant provided by the FHA Energy Efficient Mortgage and grants home buyers an additional 4% of the loan amount so they can make energy improvements to their home they are buying. These improvements can be anything from solar panels to dual-pane windows to better water heaters. One of our longest running programs is the Extra Teacher Credit Program, which is still funded through some remaining funds was initially funded with Proposition 46 in the early 2000s, and there was some funding that went in that from that proposition. The Extra Teacher Credit Programs helps teachers and other workers in high priority schools purchase homes that are close to their workplace. A high priority school is one in which the score is in the lower half of the academic performance index, and they usually are located in lower income urban areas. The highlight of this program is that staff member who works for a high priority school for at least 3 years, the interest on the down payment loan is completely forgiven. Over the life of this program, we have funded more than 2,000 ECTP loans. And I mentioned this program earlier. This is the California Home Buyers Down Payment Assistance Program. CHDAP is what we call it for short. This can be used with a first mortgage, and not just Cal HFA first mortgage, but other lenders that are looking to partner with and to serve this particular market can use our CHDAP down payment assistance. Initially funded in Prop 46, augmented with money from Proposition 1C. I mentioned earlier we will be completely out of that allocation, and we'll be working on recycled funds by the end of this calendar year. Like our other down payment assistance program, this one has deferred payments and simple interest, so borrowers do not have to make any payments until they pay off the first mortgage through the sale or refinance of the home. The need for down payment assistance is evident in our numbers this year. We are on track to write more than 4,000 CHDAP loans at an estimated $26 million. And finally, another current offering for first-time homebuyers is the Mortgage Credit Certificate. This is funded through the California Debt Limit Allocation Committee, who assigns allocations of tax-exempt bond monies. The MCC gives borrowers a direct credit on their federal income tax liability up to 20% of the amount of the mortgage taxes they have paid. There are also many local jurisdictions that administer the MCC program. Cal HFA is always assessing the opportunities that are available to us to enhance or create our programs. We are currently looking to help homeowners in our portfolio who are interested in taking advantage of the historically low interest rates. They have a desire to stay in their current home with a refinance program. Refinancing their current mortgage will offer these owners monthly payments that help them pay off their second mortgages to benefit both the homeowners and the communities they live in. These established homeowners are a helpful component in stabilizing our neighborhoods, and with their savings from the reduced payment have an additional discretionary income each month to spend in the local economy. Also, we are developing a program to offer an extra $6,500 in down payment assistance with our Cal Plus FHA first mortgage, currently available only with our conventional loan program. And we're looking for that change and perhaps an Assembly Housing Committee omnibus bill. With this change, the first-time home buyer will get the extra boost to purchase a home and will have more loan options available to them. That concludes my presentation, and I'm happy to answer any questions. I have my acting director of home ownership, Ken Giebel, with me, and I also have my director of legislation and the director of the Keep Your Home California program with me. So we're here to answer any questions the members may have.
Ms. Patterson, thank you. Why don't we hold questions till the end of this panel, and we'll move to Mrs. Hall. But we would ask all the panelists to please try to keep your comments to the allotted time schedule, as we do have 2 more panels after this and are running a little bit behind. But we do a thank you, and we'll move to Ms. Hall.
Chair, Vice Chair, my name is Gail Hall. I'm the Director of the Legislative Services Bureau of the Franchise Tax Board. Thank you very much for inviting me here today to testify. In the past, the Franchise Tax Board has administered 3 home tax credits. SBX 215 was enacted in 2009 and provided $100 million of tax credits for new home purchases. The tax credit was available for purchases made on or after March 1st, 2009 and before March 1st, 2010. The credit amount was equal to 5%, the lesser of 5% of the purchase price of the home, or $10,000. The taxpayer could claim the credit over 3 successive tax years with an amount of $3,333. The Franchise Tax Board fully allocated this $100 million credit. We issued 10,659 certificates, and we received 12,138 applications. In 2010, there were 2 home credits that were enacted, and the legislation provided $200 million for these tax credits, $100 million for new home tax credit and $100 million for first-time home buyers. The credit was available for purchases on or after May 1st, 2010 and before January 1st, 2011. Now, if there was an enforceable contract on or before December 31st, 2010, then when escrows that closed between January 1st, 2011 and August 1st, 2011 would qualify. Again, the credit was the lesser of 5% of the purchase price, or $10,000, could be claimed 3 years at $3,333. Again, the FTB fully allocated the $100 million allotted for first-time home buyers and issued 18,679 certificates, but we received 35,000 applications. The new home credit, the FTB allocated $94 million, and we received 13,715 certificates. So you can see that these tax credits were, there's a lot of participation, and they were almost fully allocated. Now, I wanted to just touch on really quickly, Ms. Patterson talked about the mortgage credit certificate program. Again, this is a tax credit against federal income tax. California does not conform to this tax credit, and we do not have a similar standalone tax credit. And also, but another tax benefit for first-time home buyers is a penalty-free early IRA distribution. And federal and state laws have this tax benefit, folks. They can withdraw up to $10,000 from their IRA if they're less than 59.5, and use that, I assume, for a down payment. And all of you probably already know that there are tax benefits for homeowners that itemize. They can deduct their mortgage interest. They can deduct points for home purchases. For federal tax purposes, many homeowners pay a property mortgage insurance with their mortgage payment, and it's called PMI. That is deductible for federal tax purposes and is not for California. And then real estate taxes can be deducted for both federal and state as an itemized deduction. So I'd be happy to answer any questions you may have.
We'll save all the questions again, and we'll move on to Mr. Delaporto.
I'm going to switch chairs so I have a little better eye contact. Thank you for that.